Happy Friday, everybody. I'm Jeff Hirsch, editor-in-chief of the Stock Traders Almanac, and this is WealthWise on Biz Talk Today TV. And I'm coming to you every Friday after the close. Sometimes we take a break. This week, I have my friend, my mate, Alex Spiroglou from the UK via Greece. So we're doing it a little bit earlier today so that, it's noon, midday on the East Coast, but he's over there in Southeast England. So it's still a different recording. But here's a few thoughts from last night's newsletter that I sent out to subscribers. And, if you want to read the whole report or subscribe, you go to stocktradersalmanac.com. And if you click on last night's issue, there'll be a link for a free trial so you can check it out, kick all the tires. So basically, market volatility was pretty bullishly crushed since the April low. There's been a host of other technical readings that we spoke about, some of the thrusts, and whether it's Zweig or Lowry, and there's been a lot of technical positive developments. We've cleared 5,500 on the S&P and 5,670. The 50-day moving average, we got through that, and then it started to turn back up. And the 200-day, we kind of gapped through that above the W123 swing bottom that I've talked about that had failed. And now we're sort of struggling to break through the election gap from the November 5th to November 6th close. But let's take a quick look at that. I'm going to share the chart here just to give you a visual. Here's that April 8th low. Some of the spiking volatility there was pretty impressive, up to 60 on the VIX, and other different fear levels were there. Struggled to get back through this 5,500 level right here at the bottom of the W123 swing bottom. And here's my trend line. It goes back to the April 24 low through the August 24 low, comes right through this March low, and then we blasted through that. We reclaimed that here at the end of April, and in the process took out the 50-day moving average in the pink line, which was descending, and now it's turned up, and that's trending upwards. That's positive. Then in early May, we've had a banner May, and that's another thing that we'll get to in a second. We gapped through the 200-day blue line here, and across the top of the W123 swing bottom there. But as I've circled here and had on this chart for a while, the orange circle here is the election year gap. We're still bumping up against the top of that, around 59.30, 59.29. So, until we can clear this pretty important level, this gap, I think we're going to probably consolidate gains here in June. So let's just look at one of my other charts over here. Let's see, that's coming up there. So this is the post-election year pattern. You can see we've had this tremendous rally, but the history of post-election years is May's pretty strong. This one was stronger than most, up about 6.2% as of yesterday's close. We see this consolidation in June on several of the different seasonal patterns for the post-election year. So we're thinking we're going to get a lackluster June. There's also some other work on the website that shows June's more recent 21-year history. But despite this face-ripping rally, S&P is still pretty flat for the year at about 0.5%. So to me, that still has us tracking sort of a more 50-50 base case, worst case scenario that I have for my forecast for the year. So 8 to 12% was my base case, was much more heavily leaning on that earlier in the year. But with this market action, it's more 50-50 with the worst case, which is a flat to negative year with all of this sort of old school Republican administration activity where they're really trying to throw everything out very quickly, more than we've ever seen. So just a quick look here at strong Mays. Everyone knows about sell in May and all these other seasonal patterns, the worst 6 months that we have, May through October. So the next, after these big Mays, you can see here 6.2%, these big Mays of 3% or more, I've got the post-election years highlighted here. We see the last 7 months pretty strong, up an average 8.7%. That's right in line with my base case scenario of 8 to 12%, and up 13. There's a few, wrinkles here, but the trouble we see here is in June, 0.5%, up only 11 of those 18 years. There's a couple of blemishes here and there, but for the most part, Q4 and the last 7 months pretty strong with a big positive May. So we've got that going for us for the rest of the year, but probably a little weak this year in June, and then maybe later on in Q3. So let's see. We're going to just wrap up here and segue in, Alex, with the perfect um, uh, technical indicator for him, MACD. The Nasdaq's best 8 months ends in June, and our MACD sell signal criteria is on the cusp. Looks like it's going to go, crossover today, which will reset our MACD sell signal, and we're gonna need to have a new trigger, a new crossover after June 1st, which is the last month of the best 8 months. So again, we'll be advising our subscribers to get out of some of our NASDAQ positions once we get that sell signal. And then let's bring Alex on. Are you there, sir?
I'm absolutely here, Jeff. Nice to be with you, my friend, even if it's just virtually. Last time I saw you were having beers, once in London, once in Athens.
Yes.
So
We've
I'm
had a
looking
couple of
forward.
pints together.
Yeah. So I'm looking forward to having a good pint with you again soon.
Maybe we could get one of our other beer swilling technicians involved. I know our friend John Bollinger has a thing for an IPA that's brewed in our area. It's called Wrench.
All right.
Um, it's pretty nice. So let me give you the reason why the segue into it with MACD is so important. Alex won a very prestigious technical award, one of the ones he's won, the CMT's Association Charles Dow Award for his outstanding research and technical analysis on his paper MACDV, which is volatility normalized momentum. He's going to explain that as we get into our chat here. He's got the NAME Founders Award. That's the National Association of Active Investment Managers. Thank you. He bills himself as a semi-systematic cross-asset prop trader. He's the founding chairman of the London chapter of the CMT, the Chartered Market Technicians Association in 2010. I've been there. I've been his guest and spoken to his group there as well as one of the founding members of the Hellenic chapter, which was a great trip that I took. I think it was the founding year, 2014, when I spent about 23 hours in Athens and saw the Acropolis and ate on the the steps going up there where all the restaurants are, where all the kids hang out, whatever the downtown Athens. And he's also still on the advisory board of the CMT Technical Analysis Educational Foundation, and most importantly, he is the founder of and CEO of Smart Trader Systems Limited in London, and we're going to get into that. So we've hung out, we've talked markets and politics and all kinds of things over the years. But where did it all start? How did you become this technical guru that you are?
I'm just a technician. I wouldn't call myself a guru at all.
Modesty.
No, I think it's a reality because both you and I participate, to tell you the truth, in a list that there are so many people there that I'm considered much more knowledgeable than me,
Oh,
and also
you and me both.
And also through one of the benefits I have, this just is a small introduction. Also, one of the side benefits of being the chairing the chapter of the CMT Association in London was that I get to meet so many wonderful technicians, and I got to learn things from each and every chapter meeting. So I got to know, people who, I think, much smarter and more knowledgeable than me. So to come back to your question, how did it start with me? It started at a very, very young age when my dad, he was working for Bank of America. And one day he took a trip in London and he went to the trading floor there. He said, son, when he came back, I think it would be good for you to become, go into trading and, work in a dealing room. And of course, as a young child of 15, I said, yes, Dad, but although I had no absolutely clear idea of what I was agreeing to do. So, fast forward a few years later, I was always attracted in economics, went to City University did banking finance in London. And at the young age of 21, at the very last year in my university, there was an elective course. It was called forecasting. It was by a professor called Roy Batchelor, with whom I'm also in touch, and also has invited me to do guest lectures in City University. So what he did, because he was an ex-floor trader, he wanted to teach technical analysis, but at that time it wasn't accepted in the academic world. So he kind of like disguised it.
What year was this?
That was in 1995, I think. So that was, yeah, 30 years ago. So what he did was he kind of like disguised it, but he put like some econometrics at the beginning, some econometrics at the end, a few in the middle, and hit technical analysis like this. So it was called forecasting. So that was my first, touch, or first time I saw technical analysis, and I absolutely fell in love with it. And
why'd you fall in love with it? What was so attractive to it?
It was very practical. I don't know. I just saw, because up until that time for the first good 3 years when I was doing my bachelor's, I was doing more of classic fundamental analysis. My dissertation was on the factors that affect dividend policy for British stocks. So everything was very fundamentally based. But as soon as saw a chart, it resonated with me. They said, look, you can see, how prices actually path, they go up and down. And I said, this really makes sense to me. So that's how I started out.
So it was the visuals of the chart.
Yep. Exactly.
So you ended up being a prop trader for a while, or at trading desks.
Yeah, I worked for various firms, a couple of hedge funds, prop trading firms. So I've both on the sell side, primarily on the buy side. On managing books, also at my last the company I worked for, we also had it was a fund, an FCA regulated hedge fund. So basically what we also set up a prop trading desk. Well, I was actually called to train people in-house for the firm. So also did some one of the largest prop trading firms in London, when I was actually the pleasure of working with Navinder Sarao, the flash crash guy.
Who's that?
The flash crash guy, the gentleman that was accused of
the whale.
Not the whale. Basically, there was in 2010, I think it was, there was a flash crash. Well, they say one guy out of London crashed the whole financial system. Well, I was working with him. Not at that particular time. We were working together just before that.
Wasn't that? Didn't they call him the London Whale? Wasn't that the London Whale, or no?
No, they called him the Hound of Hounslow, because he was working out of Hounslow at that time. He left the company we were both working for, and he was actually working from the basement of his parents' house. Although he was a multi-millionaire, Nav was literally a multi-millionaire, he was still living with his parents. Among one of the many stories I can
so
share about.
I mean, now that you mentioned it, what did he actually do that caused the flash crash? Do you know? Like,
I've seen I haven't spoken to him, unfortunately, since then. I mean, I've contacted him a few times. He never replied back. I know that he was extradited in the US. He ended up, cooperating with the US authorities there. But from the stuff I read, I wasn't entirely convinced. I think, they just needed an scapegoat.
Right.
Because I would be really, really worried if a whole financial system crashes just because one guy, spoofed a few orders, and that caused panic in the markets. That would really make me lose my confidence in the whole financial system.
Yeah, you got to think it was more than that. But so he's not one of your heroes. You have a whole bunch of technicians that you've look up to, that have mentored you. Who are your heroes? Who are your mentors? I mean, one of the guys I know we both look up to, Larry Williams. He was my first podcast guest. Larry, I've known since I was a kid, but who else are people that you rely on and formulate
Uh,
your own work from?
well, I'll tell you something. During Easter a few weeks ago, I went back home to visit my family, and
In
I was
Greece.
going. Yep, absolutely. Yeah. So I left England, went back to Greece, and I was going through some old books I had, and I think I found a copy of a stock trader's almanac. I think it was the 2000 issue, 2001 issue, and I still have it. Next time I'll see you, I'll get you to copy it. So you were the influence in my very early years.
Ah, I'm
So
humbled.
yeah. No,
Hats off to my father, my late dad.
seriously, I will bring that because I still have it. And next time we meet, I'll get you for you to sign it for me.
Of course.
I would say that a lot of people have contributed to my methodology. Larry Williams, of course, is the one of the people who influenced me a lot. I mean, and I look up to him not just for professional reasons, but also on a personal basis. He's one of the truly, stand-up guys in our industry.
Mhm.
So Larry would be one. Tom DeMark as well. Extremely bright, extremely innovative technician. I would also put John Bollinger with me. John was the one that proposed become the chairperson for the CMT Association, and that kind of like put me on the map, if you will. And if it hadn't been so for John, I wouldn't have gotten to know this wonderful, not a lot of wonderful people. So he opened up a lot of doors for me. Martin Pring is also someone I look up to because of his work he's done on intermarket analysis. John Murphy, not so much the technical stuff, but so much the intermarket work he's done. So there have been quite a few, but these are the go-to,
Goats.
yeah.
So let's get into what you've developed here. I mean, you were awarded the for the paper on MACD. What
Mm-hmm.
is MACD? What's the V? Is that
V for
volume,
volatility.
volatility?
Yeah,
So I
V for.
mean,
Mhm.
we can explain MACD to people. I mean, it's a combination of some exponential moving averages invented by Jerry Appel.
Correct.
Clearly, he's had an influence on both of us. I use it, and
Very
you've
correct.
stood on his shoulders there. So, what did you do with MACD V?
Well, let me put. Well, actually, the MACD was an attempt for me to use a technical analysis tool to measure momentum, but because and it started around, I think it was 2014, because up until that point in time I wasn't, and I mean there were so many momentum indicators out there. There are probably more momentum indicators than traders themselves. So
Hmm.
I was always trying to find a tool and use just one, because I'm a big proponent of using, creating a taxonomy of indicators and using one for trend, one for momentum, one for volatility, and not do the classic mistake of using the RSI, the stochastic, the MACD. Well, they're just basically measuring momentum.
Right.
So what I found myself around 2014 was switching from one momentum indicator to another one, because under certain circumstances I was happy with one type, and then under other circumstances I was happy with another type. And the two types basically are normalized and bounded indicators. They have a scaling, say, usually, but not exclusively, 0 to 100. So they are normalized, but it's also bounded. So the readings can oscillate past a point. And you
Right.
have unbound indicators and non-normalized, sort of like the rate of change or the MACD. Basically, these are absolute price indicators. So in certain types of environments, I mean, market environments, the normalized indicators will work best, and in others, the non-normalized and unbound. So around 2014, I said, perhaps there is an indicator that can combine the best of two worlds. take basically the good parts of normalized indicators, which is of course the scaling, the normalized scaling, because they are comparable across time and across securities. For example, an RSI that is 70, it's the same thing across time and across securities. It speaks the same language, if you will. But the problem it has is in highly trending environments, you get pegged at high levels because the market sharply goes up, but the indicator cannot adjust. I mean, because there is a limit to us how much it can expand. So that was the plus and the minuses it has. But unbound indicators, they are freely ranging, sort of like the MACD can, it can rise, as long as the market is rising, it can expand. But the problem is it's because it's an absolute price indicator, the numerical value is meaningless. So a MACD value of say 100 means nothing because it depends on the absolute value, the absolute price of the market in question. So if you take two markets that have a completely numerical value, so for example, the S&P 500 in EUR/FX, one is in 4 decimal points. The other one is measured in thousands of points. So the MACD value for the S&P 500 will be numerically much higher for the EUR/FX, but that doesn't mean that it has more momentum. It's just
the Euro-FX you're talking about.
Yeah. EUR/FX. So it wouldn't be the numerical value.
So the MACD, if I could clarify, so the MACD readings are harder to notice with the Euro-FX because the numbers are so small.
Yeah, I mean, they're meaningless, basically. They're not comparable, not even across securities, but they're not even comparable across time because, for example, the S&P 500, there is an upward bias, and the value it has right now in 2025 is many times over than it was like in the 1950s. So the value of the MACD is meaningless. You can't create overbought and oversold levels with it. You can see the trend. I mean, the MACD being above the signal
I'm cheating.
line.
I'm looking at my MACD chart while you're talking about it.
Yeah, please do. So it's completely you can't say, oh, it has a MACD value of say 100 and it's overbought, or it's -20, it's oversold.
It's different for each asset and for different time
exactly.
Period.
But even for the same security for the same time frame, I'm not talking about going from intraday to daily chart. Even if you stick on the daily chart across time, because there is an upward bias, the value will be increasing. It's an absolute price indicator.
So you married these two things.
Well, my idea was, okay, how can I combine this? Basically take an unbounded indicator and then normalize it. So obviously I said, okay, because you cannot unbound and bounded indicator. So it was either one of these two choices. For example, the RSI, like being 0 to 100, I cannot have it go above 100. So what I could do is take an unbound indicator like the MACD and then try to normalize the scaling. So the first thing to do was make it into a percentage. Of course, someone else had thought about this before me. I'm not claiming any kind of copyright on that. Well, basically they took the MACD, the 12 minus 26 and divided by, say, the longer moving average multiplied by 100. And it did the trick per market. And that's explained even better in the paper, because if one uses the MACD percentage, the PPO, sometimes people call it, percent price oscillator, yeah. You can create, statistically speaking, you can find overbought and oversold levels. So what I tried to find is where 95% of the values of the indicator readings are, and use the rest as overbought and oversold. And it did the trick, it worked. So I could find overbought and oversold there is for the S&P 500. And if memory serves, that was around 2% to the upside and 2 for the downside. So if the MACD percent went above 2%, it was overbought. Below -2%, it was oversold.
But does it give you a trigger, a buy or sell trigger, like the crossover does?
Yeah. You can still use the signal line. But the problem was with that if you did the same calculation, a completely different asset class. So for example, I did in the paper, I compared the S&P 500, the Bund and natural gas. So 3 completely different asset classes. They were normalized across time, but they were not normalized across security, which means the 2% level which was the overbought and oversold for the S&P 500, it wasn't the same for Bund or natural gas. And I think for natural gas, it was 7%, and for Bund, it was 0.7%. So it was 10 times, it needed 10 times the movement in natural gas, sorry, in Bund to become as oversold as,
Right.
So I thought that's really, really strange, because since you're comparing percentages, it should be, like for like. I mean, a percentage is a percentage, so it's completely comparable. And then I tried it with other securities, and I found that if you use, say, 50 securities, you have to find 50 different overbought and oversold levels. And I said, that's not practical, but it's also weird. Why does that happen? And the observation was, what is different about them? And what I realized was that they have different volatility structures. So instead of normalizing by price, having the denominator being price, I normalized it by volatility. So the formula remains the same, 12 minus 26, divided by average true range. And of course, you multiply it by 100 to have no percentage base. And that worked like magic. So because
instead of the 9-day moving average of the difference of the 12 minus 26, you do the average. You do the average true range. Is that what you're saying?
The right. So it is EMA 12 minus 26 divided by average true range 26. The signal line remains the same. So it's the MACD line that I'm changing, not the signal line.
Okay. So you're doing. Go ahead. Yeah.
So that was as far as the paper is concerned, because I have also unpublished work, which I have changed the signal line as well. But let me refer to it a bit later on.
Yes.
So for now, what I did was I normalized by volatility, which is 12 minus 26 divided by volatility. So basically, I took momentum and find what that momentum is in relation to its volatility. And that normalized it across securities and across time frames. So basically, if momentum is 1.5 times its volatility, then it becomes overbought. If it's minus 1.5 times its volatility, then it's oversold. And now I brought in the signal line, and in conjunction with that, I managed to create a lot of patterns. So overbought and oversold, I managed to find that's 150 and minus 150. Again, that's better explained in the paper. So I thought, okay, that was the first step. So that's overbought and oversold, the risk level, as I call it. Right. But how can I find if a market is going fast? Because that's overbought and oversold. But so how can I distinguish a market going slow or fast? And then I thought, okay, if the market is going fast, that means that the slow moving average will be faster to catch up than the slower one. So which means that will cause the MACD line to go up, increase. But what is the cutoff point when there is enough momentum, enough of a spread, if you will, to signal that that market is going fast? So that was the 50 line. So basically, when the MACD is above the 50, that indicates a very strong market.
We're talking the same thing as the 0 line on the histogram, right?
No, it's the you can see that. Yes, exactly. The 0 line on the histogram. Yes. Right. But so that's the 0 line on the histogram, meaning that there is a crossover. But what I'm talking about is actually the MACD line. Its absolute value, if it is above 50, say 51, 52, 60, 67, that indicates a market that is trending up fast.
Okay, not the 0, yeah.
So the same thing on the downside. Now you have 150 fast, overbought, above 50 and 50 and 150, that's going fast. Now, if I bring in the signal line, then you've got 6 different configurations. So it's above 50 and above the signal line. It's above 50 and below the signal line. So this created 6 patterns. And the last pattern I found, which is to conclude the 7 core patterns, the 7th one, was the ranging range, which I thought, then I noticed something else. If the market was above the 50 line, it meant that it was going very fast. But when the MACD was oscillating around the 0 line for a prolonged period of time, that was happening because it didn't have enough momentum to take it above 50. So I said, okay, so if it stays between 50 and minus 50 for and I qualify it for 20 bars, that indicates a trading range because the market is not strong enough to move it upside and downside. So by that, I created a way to have on a systematic and real-time calculation of when a market is ranging. So when the MACD is between 50 and minus 50 for 20 bars, qualified for 20 bars, then the market means it is in a trading range because the MACD cannot expand.
Now, how are you making a trade with this, or an entry or an exit?
All right, I don't use, well, I'll tell you what I don't do. I don't use the MACD for signals. I use it as a setup.
Okay.
Right. So my methodology, it's 12 steps, 4 steps macro, 4 steps technicals, and then it's my how I put everything together into a system. And my system is what I call the 4S framework. It's a setup, a signal, a stop, and size. So the MACD comes in as a setup tool. It doesn't come in as a signal tool. There are various patterns that I use in conjunction with the MACD that allow me to give me a bias whether the market should be played on the long, on the short side. The actual entries themselves will come from price, bar patterns, and so on forth. And I don't use the MACD for signals for various reasons. First of all, is that the crossovers between the MACD and the signal line sometimes are a bit late. Now, I have found a way to remedy that, to completely discard, if you will, the signal line. And also because, so that was the first reason, is that they're sometimes late. And the second is, in terms of divergences, price will be, for example, let's take an example of a bearish divergence. So the momentum will be going down, while price will continue going up. And then I started, starting to say, okay, look, I'm buying price, I'm not buying momentum. So I have to concentrate on my my signals through price, not through momentum. In the same way that I try to not use fundamentals as signals. So I stay very pure with price as far as signal generation is concerned.
So you're saying that the crossover is often late. It reminds me of the, notorious death cross of the 50-day moving average crossing below the 200-day, which we've seen, especially most recently in April, as being the bottom. So
Correct. Exactly.
How do you get a signal earlier than the late crossover?
Well, if you're talking about the death cross and the golden cross,
No, I mean,
no.
Go ahead.
Yeah.
No, that's
basically that's a MACD of 50 and 200 basically.
Yeah.
So one could use, actually I was using this for a long time as a setup. So I wouldn't be using it as a signal. And then I've started finding that even that as a setup sometimes may be late. And in which cases was it late? When the market was moving downside or upside very, very fast, very abruptly. And the moving averages didn't have enough time to catch up. And when they did, then it was already the bottom, as you very correctly pointed out last April. So in order to remedy that fast moves, I had to find alternative ways to filter out movement and indicate so basically a bear market other than the moving average crossover. Because if someone says, okay, a definition of a bear market would be the 50 moving below the 200, yes, in certain cases it could work, but in other cases it would be very late. So I have to find different rules where the market moves very fast they would trigger instead of the moving average crossover.
So as an example, you know, we use the MACD in conjunction with our seasonal switching strategy. We had a sell signal for the Dow and S&P on April 3rd when the MACD crossed through the signal line on the 1226.9 for both indexes. What did your indicators, or was there an indication you had to either not sell or sell earlier or buy back in? How did your system navigate the recent volatility that we had in the U.S. markets? Can
Good.
you give us a little?
I could,
Yeah,
you know,
yeah.
I don't know if I could share a chart if you
You want to
will.
throw up a chart? I mean, I'm kind of curious as to how the smart system might have either not made a move or made a move earlier or
Absolutely.
differently.
So I've got it on TradingView here. Everyone can use that. So let me close
Oh
this.
yeah.
All
And
right.
you've got
Okay.
your indicators plugged in here?
Yep, it is. Right. So okay. So what I do is always start on the weekly chart. My operating time frame to take trade is the daily chart. So let me clarify this. I don't do intraday trading, and everything I do is on the daily chart. So what I do is start on the weekly chart, okay, and do purely fundamentals there. And when I say fundamentals, I mean intermarket, commitment of traders report, sentiment, and seasonals, okay? So I hardly look at any kind of fundamentals on the weekly chart. So this is a purely commitment of trader report.
This is your roadmap from your smart trader systems. Where can people find this?
The roadmap actually is here. Let me right. So can you see the?
It's a really good chart you have that you sent me.
All right. Yes. Let me see if I can switch from new share. That one, I think you want me to show you. Can you see it now? Can you see the roadmap? Well, okay, let me, so this may make sense. So what I do is I go look at the macros here on the weekly chart and look at intermarkets, commitment of traders report, sentiment, and seasonal. So this part was where I got really influenced by Larry and Martin Prink. Because even as a starting technician, I always felt that something was lacking from technical analysis, because it was answering the question when, and it was a perfect tool for that, but it wasn't answering the question why. And maybe it's my twisted mind. I always wanted to know the why. So, but why is not a technical question; it's a fundamental one. And Martin Pring and Larry Williams,
technicians don't care why.
Well,
pure technicians.
Yeah. I mean, but for me, I don't know. I wanted to know why. Maybe it's, I don't know. My mind's a bit twisted. So Larry and Martin helped me answer these questions, each one with their own methodology. Intermarket primarily came from Martin Pring and also John Murphy.
Yeah.
And the rest, commitment of traders report, sentiment, and seasonals. Of course,
Larry.
seasonals, you also had a big part in it as well.
Yep.
So what I do is I look at the chart on the weekly, on the monthly chart, on the that particular time frame, and then I get my directional bias. And once I have that, then I go into the daily chart. So my daily chart will include trends, relative strength, momentum, and volatility.
Okay.
And once I've got this, then I take a trade, setup, signal, stop, and size. So it's a step-by-step mechanical process which I follow.
And you
combining
do this for all markets?
Yes, all futures markets. I don't trade stocks.
Okay. So you're talking about
FX,
stock index futures, bond futures,
commodities. Yes, exactly.
Commodity futures.
Exactly. So these are the absolutely. So following this step-by-step framework, if you will, it helped me merge macro and markets, and also do it in a systematic and rules-based way.
So go back to the chart and show me one of the signals. Let's see how this works a little bit.
Yep, absolutely. All right, so S&P 500. All right, so this is the
Weekly setup.
all right, so now this is the weekly setup. So this is what I would look for. So as you can see, the MACD, sorry, this is the commitment of traders report signals I get. So as you can see, some signals are larger and some are smaller.
The triangles are a commitment of traders.
Yeah. So, but this is a setup. It's not a signal, which means once I've got that one, then I go into the daily chart to take the signal. It's not systematic in the sense of I had the signal Monday morning, I will go out and buy. And
zoom into March, April. I want this red triangle there in March is catching my attention. March 10th.
Yeah, and this is the one that I got for the bottom. And as long as it remains valid from a commitment of trader report, yeah, this is at the bottom, the commitment of traders report. I've got it. I have the bars color coded in green or red, telling me that there is still upward bias for this. So for the past 1, 2, 3, 4, 5, 6, 7 weeks, I have a directional bias to the upside.
Mm-hmm.
And so that automatically means that I can, of course, that is one factor I look at, as I mentioned, seasonal, sentiment, intermarket. So then I go into the daily chart to actually take the position. Obviously, the indicator stops working now because that's based on data. And what I do, I start, first of all, look at the trend. And for the trend, I look at what I call a market map. Basically, I divide the trend, not just bullish or bearish, in 8 stages. So think of it like a sine wave.
Mm-hmm.
So the upper part of the sine wave is uptrend. The bottom part is downtrend. So I don't look at it purely in a binary like bullish or bearish, because during an uptrend, you have an impulse move, and then you have, basically a trend move and a counter trend move. So I wanted to see into the data a bit more. So when you're in an uptrend, I wanted to see, when you're going with the trend or you're having a correction against the primary trend. Think Charles Dow, when he talked about the various types of trend. So all in all, I've got 4 stages for uptrends and 4 stages for downtrends, 8. So again, color coded. So I know exactly where I am as far as the trend is concerned. And that I look at it in conjunction with the MACD, sorry.
Mm-hmm.
Right, so then I look at the MACD, then I look at volatility, and I haven't shown this piece of my work. There you go, volatility valuation. Now, this is, let me squeeze this. This is also a very, very interesting indicator. And I got inspired this from John Bollinger, because one time he came to London and we met with our wives, and he mentioned low volatility is where trends are born. High volatility is where they go to die. And that phrase stuck with me. And although at that time I didn't know exactly what he meant, because up until that time I hadn't noticed it myself, but instinctively I thought, this sounds important. I may not know what it is. I probably don't understand it, but remember it. So it always stuck with me. And after I started studying a bit of volatility and found that, look, this is true. I mean, whenever there is a big trend, and it usually ends on high volatility, not always, but that is true. It's especially true for equity indices, not so much for commodities, because they have a different behavior. So my second step was, okay, now that I've observed it, how do I quantify it? How do I flesh it out? So I created this indicator. Let me squeeze in a bit the MACD so we can see it a bit better. So what it does, this one, it quantifies when volatility is too high and when it is too low. And as John correctly mentioned, high volatility is where trends go to die. So high volatility that ended the bottom. High volatility here, the bottom. High volatility here, the bottom. High volatility here, the bottom. So I use it in conjunction with
The high volatility at the bottom is inherently an easier trigger to see.
correct. But high
how about
volatility.
the top? How about the top
right,
part?
Right. So for the top, sometimes, well, volatility first of all is trend agnostic. So you can have high volatility in tops as well. Now, that's
On
where
paper it is, but in reality, high volatility occurs at bottoms more than tops.
correct. But one caveat, that is true mostly for equity indices.
Yeah.
If you look at commodities, it's the other way around. They usually have blow-off moves to the upside. So most of the times you will find that high volatility is associated with tops. So I would say that observation is correct, but it's also asset class dependent.
That's valuable. Yeah, yeah.
Circling back to the S&P 500, again, I'm not I try to not be a one-trick pony, but look at this from a multiple time frame point of view. So I look at it in conjunction with a MACD. So that really helps a lot. So for example, here, I had both the MACD below 150, so that's the risk range, and volatility valuation showing that there is too much volatility. So I use the same thing to the upside. Now, if a top can be either due to very high volatility or very low, so very quiet, something like this. So for example,
what are the purple are those signals? The purple symbols there?
No, that's the trend. That's the trend. So the color coding of the chart is based on this 8-stage framework I mentioned based on the trend. So here I see the trend, here momentum, and here volatility. Now,
so for example, in the current market, we had a MACD sell signal for S&P on April 3rd.
April 3rd.
Arguably,
my latest thing was April 3rd. Yeah, okay.
Arguably a little bit later than we would have loved, but it is what it is.
Correct.
Was there something that we could use from your indicators here to perhaps have gotten out a little bit earlier or not gotten out? I mean, the buy at the bottom there is a little clearer, but
I see what you mean. So basically you got it here because there was the crossover.
Yes.
All right. So in my case,
in our seasonal window after a new crossover on or after the first trading day of April.
All right. Okay. So so you got it here, right?
Yeah.
All right. All right. So this is the daily chart. Now remember, I always have my bias on the weekly chart, not on the daily. My daily is on the execution side. So what I would do is go back to the weekly chart, and then here you would see that the next week I had the buy signal, a buy alert, if you want to be completely honest.
Yeah.
We like being honest. Based on the commitment of traders report.
Right.
So then I would go to the daily chart and look for a buy signal. And how would I do that? I've got a system that generates buy and sell signals. Now, obviously,
so since hold on. That's short, just before the April. What day is that?
Here, March
27th.
Yeah, 27th. Yeah.
That's the day we fell below the 200-day again.
Right. Okay, now I'm going from switching to topic. Right. These buy and sell signals, I only take them if I have a directional bias. So this, since I was bullish based on the commitment of trader report, I would be ignoring sell signals. All right.
The current ones, right?
Yes. So this is how my chart would look like from that point onwards. Because
so since the bullish bias would have avoided that short signal back
Correctly.
in March 27th.
Correct. And that's why I have it on an on and off basis. Now I'm showing it just for reasons of completeness. All right. So buy and sell signals for me are just a way to manifest my fundamental bias. So if from a fundamental point of view I'm bullish, then I'm waiting for the market to confirm via the trend and then start look for a buy signal. Hence the color coding of the trend. So first fundamentals, then I wait for the market to start manifest this bullish bias into a positive trend, and then my signals come in.
So the COT report is the biggest input in the fundamental bias.
It's 25%. Yeah, it is big, but it's 25% because the COT report has two problems. One, of course, it can be wrong, like any other type of data series, and the second, it doesn't always speak. I mean, in this particular case, it was exceptionally good. But I'll tell you from experience, it doesn't always work that well. And
nothing
B,
does.
Yeah, of course, and it will not always speak. So a bottom or a top may form without having a signal. Well, that is my interpretation of the commitment of traders report. So I need to have other tools as well that may signal. So one is sentiment, one is intermarket analysis, and the other one is seasonal.
I can look at these charts for hours with you, but I go back to the macro weekly setup and just show me the other three inputs and what their score was.
Let me eliminate this.
So you had the COT and
sentiment. So obviously sentiment. All right. So this is a sentiment composite. This is another one. So basically my sentiment composite is not just one piece of data. I have various types of data composed into one, because again, you run into the same problem. You may use 3 or 4 different sentiment data, and not everything will speak, but you can combine it. So at this time, you can see that it was blue, which means it's an alert on the panic side.
Yeah.
So on the top, I have alerts for too much greed, and at the bottom, it's too much.
And are you looking at the survey sentiment stuff or put call or?
Various stuff. Basically, the main thing is that I have it in one. You can combine it. I mean, there's so many. The main idea is here to combine it into one. I think that's the main edge I have here. So the blue color indicates that it is, say, an technically speaking, oversold level. Basically, it's at a panic level, but it still has a downward bias. So you should be careful. Meaning that, yes, there is a downward bias. So yes, it is at an extreme level, but it can be extreme more than I can afford to be. I can't speculate on when it will reverse. It's just telling you, watch out for a bottom. So at this point, I had 2 pieces of data telling me that a bottom was approaching. First of all, it was the COT report accumulation, if you will, and also had, from a sentiment point of view, the warning that the market was there was too much panic in it. So once I had this, so from this week, the week of 10th of March, I had a sell signal on the commitment of traders report, which of course you can follow, but it was the blue color was telling you it's getting overstretched. Purely from a trend following point of view, you can continue shorting because it's telling you, there is a sell signal, although you must be careful. So as soon as the buy alert came up, it was on the back of extreme sentiment, then you can let it roll. The most actionable signals, alerts, are the big ones. The small ones, on their own, unless they're used with momentum or with volatility, they usually just make a sideways move, more of like a corrective move. So this is how it looks like on the S&P 500. You can look at another chart if you will. I mean, another asset class. Let's, for example, look at fixed income, 10-year notes. Again, it's the same idea here. Let me take this out. So again, what I'm trying to find is a bias. So each of these, I have a bias. Then I go to the daily chart for my signals. For the 10-year notes, for example, I had an alert 16th of September. Actually, strictly speaking, because how TradingView gives you the date on Monday, actually I didn't get it on the 16th, I got it on the 20th because that's a Friday. So for example, for next week, I will get my signals as of the close of today. So it says Monday 16, but it's not Monday 16. It's just it's at the end of that week. So so it was Friday, the 20th of September, and then I had a bearish bias for 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. So I was looking to short this during this period, which obviously I would be doing on my daily chart, not on my weekly chart. Now let's look at the latest situation. Again, I had a bearish bias looking for short signals in fixed income for this time period. And now I have an alert that there is a different sentiment. There's a bullish sentiment. So might want to be a bit careful with them shorts.
Covering your short here.
Yeah.
All right. Listen, let me get into what you're doing. Otherwise, let's pull down your chart. You get me mesmerized with charts. You know how I roll. So tell me about your trading community and your vision for smart trader systems.
That's a good question. Well, basically what happened was after the awards, I started getting contacted by a lot of people. Can you show me the MACD? How does this work? Also because I was getting invited, actually before that, I was getting invited to speak at various events. And I got a lot of people asking me, how we can do this, how we can learn about this. And I thought, okay, how can I teach this, if you will, but do it a bit differently? And I say differently because I think there is too much emphasis on theory rather than practice in education. And because trading is very, very practical, and we shouldn't be focusing on information, but on implementation, how can I twist things and focus on implementation instead of information? So what I thought is I'll give the course for free and also focus on implementation. Now, implementation could be obviously, me showing the trades live and so on and so forth, but also doing it within a community environment instead of one-to-one via email. And then you can have, like, say, 3 months access to me. This will be an annual subscription. So that will solve the problem of someone, there you go, you can email me anytime you want for 3 months. No, but someone wants to learn at their own pace. Or, something happens, they have a problem with their wife, their children, or at work. So what happens, if these 3 months or 4 months expire? So you want to give them time. So that's why I made this whole thing into an annual subscription and also a community environment, because we can be learning off of each other. So that was the problem. So give away the course for free for people who are interested in just the information. And then for someone who's a bit more committed, come for the implementation.
So what do you show people in the implementation? I mean, how does it work? What's the community like?
Right. So let me put, first of all, this is currently being launched as we speak. So
and where do people find out about it? What is it?
They can visit my website, www.alexspiroglou.com, first-last-name.com, and I just have the community there. I haven't set up the actual website in the sense of about me, what I do. So I've just put up the community there. I'm hoping by July I'll have the actual website as well. So this is where people can register, and the implementation will focus on, first of all, me showing my trades real time, so they can see how I apply the theory, basically.
So
and
people are going to be paying an annual subscription to watch you trade and learn from you trading live.
exactly. So everything will be recorded there. There will be timestamp, so they will see everything I do, and whenever I lose money, whenever I make money, my reasoning behind it, the mistakes I do, because I still make a lot of mistakes, and
No.
I'm just trying to correct them and learn from them. But I'm human like everyone else. So I will be exposing my strengths and my weaknesses before everyone. So that's one part of the help. The second one is what I call coaching, in terms of having a forum. Someone can ask questions. On this chart you said
Right.
you would do this, but now you did this, or I don't understand that. But everything
Right.
will be archived so people can access it, so we can learn from each other. Because it's different, for example, if John asks me something and it's a different situation. If John asks on a forum, and people can see it and learn both from the question and the answer, because you can, someone can ask a question and say, "Oh, that's smart. I hadn't thought of that."
One of the things that our subscribers, our newsletter subscribers, enjoy the most is our monthly webinar, where we pretty much spend an hour taking questions from everybody, so everyone's hearing what everyone else is asking, learning from each other. It's not quite as interactive as what you're talking about, but
But still, it is very.
it's a
It is,
favorite. I mean, and I learn a lot from people there too.
of course.
We get a lot of good questions, things we look into later. So
Jeff, someone said the best way to learn something is try to teach it, because you have to prepare for it, and it's primarily a learning experience for me,
yeah.
rather than before anyone else learns. I have to learn it myself.
So what are you trading these days? Right now, today, this week, next week? What's on your
I had
radar?
a, I had a long
What's good?
position. I'll give you my position. I had a long position on the S&P 500. I closed out some shorts on Treasury year notes, and also looking to get long positions on gold. I can give you my setup score.
Sure.
Right, so my
And you're
setup.
just trading for your own account now. You're just you and
No,
your
I
own.
don't. I don't do client money anymore.
No, just yourself.
Yep, there you go. Setup score. So this is the. Sorry, let me erase this. So I've got. These are my long
Bitcoin.
candidates and my short candidates. Okay, that was last week. So obviously this week I will have to, because I update this every Saturday, because I have the new commitment of traders report and the new weekly
Yeah.
sentiment. So that was, I was looking for last week, potential longs and shorts, and then classified based on what I think has more probabilities, sort of like grading it: A trades, B, C, and D.
Mm-hmm.
And this number is the relative rank, relative strength. So within each part, I always put more emphasis on something that has more relative strength. So for example, a B trade would be Bitcoin and Cocoa long. But between these, I would give slighter emphasis on Bitcoin because it has better relative strength than Cocoa.
And cocoa is a tough commodity to trade anyway.
Yep. So this would
And
be my long.
it looks like your S&P long is kind of a little weaker.
Yes, correct. It's a C trade with less relative rank, because it's just still recovering from a big
Yeah.
decline.
Yeah, and it runs in with the seasonal work of the big May move consolidating in June.
Yep. So this is my setup score, if you will, my watch list, if you will. I drop each week, and I do this on Saturdays, and
And
then
this goes to the
Monday through Friday, I go simply on the daily charts. I don't look at the weekly charts anymore, because all the work
okay.
has already been done.
So this is for your own personal use, or is this what you're sharing with the community?
Currently, just for me, but it will also be shared with the community as well. So
Okay.
everything I do will be there, both
That's
right and wrong.
that's
So
worth the price of admission right there, man.
I think so. I mean, it certainly hope so. It will be as transparent as it can be. Both the theoretical part, the course, will be, as I mentioned, will be for free, and the practical part, again, will be everything. We're there for people to see what I do.
So switching gears a little bit, you're a man of the world. Clearly, we're talking across the pond. You come from Western Europe. You're in the UK now, and it have been for many years. Any thoughts on what's going on over here in the States on Trumponomics? What's going on in the world these days? Any feeling? Does it matter? Is it all noise, or is there something?
No, it matters. I think it does. Obviously, it does matter because Trump has taken a very radical approach to trying to create business. What I think he thinks is best to create business for the United States. It's completely unconventional. We'll see how it goes. I mean, you can approach this either through the data, or you can see this either from the market's point of view. In general, I'm not an excellent, I would say I'm probably below average as a political commentary, understanding the inner workings of politics. So I try to see this either from the data, whether that's fundamental or primarily technical. I can give a half-educated view on what I think will go. I think in general, I think interest rates will go down. Again, I'm not saying something novel here. A lot of people see
No,
this. But the difference is the question for me isn't so much if interest rates will go down, but at which intensity they will. So how fast they will. I think that's the crucial point. Perhaps we can be looking for something from the September 17th to start having, say, 25 basis points cut, the first cut, something like that.
you think the Fed needs to see something really go wrong to have a fire to put out, or are they going to just?
I don't think that the situation will be. We may have a slight slowdown. I don't see anything close to a recession going that far. The problem is that we may go and enter something like a stagflation environment rather than outright recession or something. I think in the immigration policies that Trump has will reduce supply of labor. Tariffs. These deals basically tend to take time to work out. Now,
Yeah.
they can go faster, it can go slower, but in between, it creates uncertainty, and that delays business spending because people don't know under which environment they will be operating. Again, that will slow down growth a bit. And I actually read somewhere that a 10% increase in tariffs creates around a 0.8% increase in inflation the next year. So we might start seeing some increase in the inflation numbers in the not so distant future. So 6 to 8 to a month, 12 months from now, we might start seeing inflation picking up because of the aftermath of the tariffs. Now, I don't think it's going to be like 1970s or 2022 even,
Right.
but still, I mean, so I think that paints a picture of probably around stagflation, slowing of growth, bit of inflation. So from economic point of view, again, but this is what I'm saying is half educated. As far as taking action, it will always be through my 12-step methodology. But what I'm just expressing a view here is like talking to a friend and having a beer and talking about philosophy or politics or something. It's not actionable if you're.
Seems like you're sensing that what's going on with this administration and in the world right now, that it's going to keep stocks at bay a little bit. You're going to keep equities
Yeah, most likely yes, most likely yes.
and
I think that
potentially have a bigger negative impact next year, and
yeah, I think so.
which
I think
lines
so.
up with the 4-year cycle, midterm election year stuff. I think some of Larry Williams' cycle work that we both looked at.
I'm not too awfully worried about it right now
No.
because the American economy is still strong enough to sustain this type of the implications of the tariffs. But next
Both,
year out, it
both
might
the
be
market and the economy have shown some serious resilience.
exactly. So I'm not too worried about it as of today.
So what do you think about this rally? Are we going to retest the lows? What do you see is happening with this market over the summer? Anything big, or are we just going to kind of mark time till we get through some of this
I'll
stuff?
just to tell you that I'll just follow the indicators. That's what I do. That's why I had created this rules-based methodology, so I don't have to force myself
Right.
into a view.
What are they?
Because so when I see basically when the market, if it turns to the as long as my macros on the weekly indicate the bullish bias, and it is being confirmed on the daily chart, I will keep buying it. If it
So you
turns, then I will stay out. The macros change, then I will start shorting it, because I have three options, buy, short, or stay out. So I've tried. That's why I've tried to, it's imperative for my own psychology to be everything rules based.
so you're not looking any further out than 1 week at a time.
I do. Well, most of these from an actionable, from a trading point of view, I don't. I do have some positions on ETFs. But again, I look at this again on a weekly basis, but these are more long-term positions. But by and large, again, I live from Monday through Monday. I don't try to think out more than that.
So let's sort of wrap up a little bit here. What are you doing other than the markets? What are you doing for fun these days? What are you doing to keep your psychology straight? So it's not all markets and indicators.
I'm trying to go on a diet. I'm constantly on a diet, battling with my weight. No, I like
The
swimming.
beer's not going to help, man.
I know. Well, I like swimming. Going out with my wife and friends. That I really enjoy. I have very, very good neighbors here, and have barbecues. Again, doesn't help
That's a
with.
very American thing to do over there in
I
England.
know it is. We have a very nice yard, and invite friends over, have barbecues. Sometimes fly home. I like traveling a lot.
Yeah.
We are also having a daughter come in a few days from now. My wife and I have recently adopted.
Excellent.
Yeah, so I will become a father. So that will also take a lot of time for from my time, probably more of my free time.
So you're launching the new website. You got a new child
coming in, yeah.
And you're going to try to lose some weight.
Absolutely. Let's catch up in 6 months from now and see how I'm doing.
For sure. Well, just to remind everyone where they can go to find out more about you, it's alexspiroglou.com, right?
Yep. Or they can email me directly, alex@alexspiroglou.com.
And you could just Google him. He comes up pretty easily. Any speaking engagements coming up anywhere? Any events? Anything?
Yeah, quite a few. I mean, I'll be doing the IFTA conference in September.
Oh yeah.
Yeah, in Frankfurt, in Germany.
I think I'm going to be there too.
Really? Oh, that's
in San Francisco.
No, the IFTA, not the CMT. In Germany, that's in Germany.
You're going to be in Germany.
Yep, in the IFTA, the International Federation of Technical Analysis, not the CMT.
No, there's a TS, the technical one.
Society of.
Yeah, analyst. That's in San Francisco in September. No, so we'll be.
All right, I'm talking. No. I'm talking about one in Germany.
Germany.
The IFTA, that's the International Federation of Technical Analysis. They have a big conference. They invite me for in Germany. Also have in London 3 other engagements, and a series of webinars I'm doing. Probably I haven't set up the exact dates, but probably it should be June and July. So I've got almost something on a bi-weekly basis.
Well, hopefully one of these days I'll either be over in Europe or you'll be in the States, and we could hang out in person and share some more stories.
I would really love it. Where are you based exactly in the States?
I'm in New York. I'm outside the New York. I'm in White Plains right now at the office.
All right.
Just a half hour from the city up the river.
I definitely have to visit. I really, really will. Believe me, you will be the first person I call up when I visit New York, and I really want to do it.
Would love to have you. All right, my friend. I'm going to let you go. Thank you again for coming by.
Thank you so much for the invitation. I really enjoyed it. For me, it wasn't like an interview. It was, speaking to a friend, talking charts, something we love. It was probably one of the most enjoyable interviews. But again, it wasn't it. It was just speaking to a friend.
Very cool. So thank you again. Thanks everyone for stopping by. And again, I'm Jeff Hirsch for WealthWise on Biz Talk Today TV. I'm also the editor-in-chief of the Stock Traders Almanac. You can find out about me at stocktradersalmanac.com or just Google me, hit the like, send it to your friends, and we'll see you next week.
Get the almanac.
Get the almanac. I'm putting the 26th to bed right now. So happy Friday.
Thank you. Thank you, Jeff. Bye-bye.